Welcome to Iron Financial, the channel where we forge stronger portfolios by stress testing companies right down to their financial bedrock. And today, a real titan of the trucking industry is in our forge, Old Dominion Freight Line. Their Q4 earnings just hit the wire, and you know what? Wall Street is hitting the buy button hard. But when you look under the hood, really look, you see a glaring contradiction. It's a paradox. Glaring is an understatement. Honestly, it's a bit shocking. We're looking at shipping volumes in an absolute free fall, down over 10%. So the multi-billion-dollar question we have to answer today, for all of you, is this. Why on earth is Wall Street rewarding a company that is fundamentally moving less stuff? It just makes no sense on the surface. Okay, let's dive into this. We are not just skimming the surface today. Nope, we're going to break down the entire foundation of this company piece by piece. First up, we're going to tackle that earnings paradox head-on. Then we'll deconstruct their revenue engine, figure out what's really driving the money here. After that, we are going to inspect their cost control fortress to see if it's actually holding up under all this pressure. From there, we'll follow the money, see how they're handling their capital with a section we're calling Forging Shareholder Value. And finally, we will deliver our verdict. Is this company truly built to last, or are we seeing the first dangerous cracks in the armor? All right, let's get right into it. Section 1, the earnings paradox. This is where the confusion starts for most investors, and frankly, where the big debate begins. The headlines are all screaming, beat, beat, beat. But the reality on the ground, well, that tells a very different, much weaker story. Now, look at this. It's like you're looking at two different companies. On the left, you've got the headline results. Earnings per share came in at $1.09, when the street was only looking for $1.06. Revenue was $1.31 billion against a $1.3 billion estimate. So on paper, this looks like a solid win. They cleared the bar. But cleared the bar? They tripped over a bar that was lying on the ground. You have to look at the right side of this slide, the year-over-year reality. That's what matters. EPS is down 11.4%. Revenue is down 5.7%. That's an $80 million drop in revenue from this time last year. Beating a lowered estimate isn't a sign of strength. It's just a sign of how incredibly low expectations have fallen. Are we seriously supposed to celebrate a nearly 6% drop in business just because a few analysts guessed it would be even worse? Come on, this isn't a strong foundation. This is just less bad than people feared. But you're missing the point. In what the CEO himself calls a challenging operating environment, managing expectations and executing better than the consensus, that is the mark of a well-run machine. It shows discipline. The market isn't rewarding weakness, it's rewarding resilience in the face of a pretty brutal freight recession. They told the street what they thought they could do, and then they went out and did it better. That's a sign of control. And that resilience you're talking about brings us right to Section 2, deconstructing the revenue engine. This gets to the absolute core of the paradox. How in the world do you make money when your core business activity is shrinking so dramatically? Well, it all comes down to a brutal tug of war between pricing power on one side and a total collapse in volume on the other. Okay, the crucial point is right here on this slide. Look at the left side. The problem, it's undeniable. Tonnage per day, which is the actual weight of the freight they're moving, it plummeted 10.7%. Shipments per day are down 9.7%. Their trucks are simply not as full. There's no way around it. But then look at the solution on the right. They are charging more for every single shipment that's left. Revenue per shipment is up a healthy 4.6%, and revenue per hundredweight, a key metric, is up a very strong 5.6%. This is a testament to ODFL's premium service. Customers are willing to pay more for their reliability, even when the market is weak. That, right there, is the definition of a strong brand and a rock-solid business model. Or, it's the definition of a company squeezing its remaining customers for every last drop before they finally walk away. How long can you sustain this strategy? Raising prices while your trucks are getting emptier is a very dangerous game. You can't defy gravity forever. At some point, customers are going to find cheaper alternatives, especially when the entire market is soft. You're over here celebrating price hikes, while the actual business, the thing they do, moving freight, is eroding right out from underneath them. Okay, let's just move to the hard data. This table lays it all out, plain and simple. Yes, as you said, the tonnage and shipment numbers are weak. I'm not going to dispute that. But look at the yield metrics. Look closer. Revenue per hundredweight is up 5.6%. And here's the kicker. Even when you strip out the volatile fuel surcharges, it's still up 4.9%. That is pure pricing power. That is what we call revenue quality. It shows they aren't just desperately chasing low-margin freight to fill their trucks. They are protecting their profitability at all costs. This is what best-in-class operators do during a downturn. Protecting profitability, or are they just masking a deeper, more structural problem?
The number that really jumps out at me isn't even on this slide, but it's buried in the report, and it's this. The 2-year stack decline in tonnage is a staggering 18.9%. Almost a fifth of their volume has vanished in 2 years. You can talk about revenue quality all you want, but if the underlying structure is shrinking that fast, you're not managing a downturn, you're managing a decline. So the real question for investors is this a temporary cyclical dip, or is this company actually losing its grip on the market? And managing that decline effectively is exactly what separates the winners from the losers in this industry. So let's get into Section 3, the cost control fortress. Look, in a tough market, top-line growth can be elusive. The real test of strength, the real measure of a management team, is cost discipline. And this is where Old Dominion has built a reputation for being an absolute master of efficiency. And this number, this brilliantly illustrates their discipline. Their operating ratio for the quarter came in at 76.7%. Now, what's key here is that management guided the market for a sequential deterioration of 250 to 350 basis points. They came in better than that at 240. So they told the market things would get worse, and then they performed better than their own forecast. That is execution. Hang on. Better than a terrible forecast is still not good. That number, 76.7%, is 80 basis points worse than it was in the same quarter last year. Efficiency is going in the wrong direction. Costs as a percentage of revenue are rising. The fortress is taking on water. You can't just look at it sequentially and ignore the clear year-over-year degradation. They are becoming less profitable on every single dollar of revenue they bring in. That is a crack in the foundation, clear as day. But this wasn't an accident. This is all part of a strategy. Look at what the CEO, Marty Freeman, said directly. Old Dominion's fourth quarter financial results reflect our ongoing commitment to revenue quality and cost discipline in what remains a challenging operating environment. This isn't a company panicking. This is a deliberate, focused effort to navigate a storm by controlling what they can control. The narrative here is one of intentional, disciplined management, reinforcing the walls of the fortress. Every CEO says they're focused on discipline during a downturn. That's page 1 of the CEO playbook. The numbers tell the real story. And the numbers here show that despite their best efforts, their margins are compressing. Talk is cheap. Show me the numbers that prove this discipline is actually winning the war against rising costs. Because right now, I just don't see them. Well, part of that discipline involves making some tough choices. This slide shows the heavy lifting. They've reduced headcount by 6% year over year. That's a necessary structural reinforcement to align their costs with lower demand. Yeah, it's painful, but it's what strong companies do to protect the bottom line. But it's not working. Look at the other bar. Salaries as a percentage of revenue went up by 180 basis points. They cut 6% of their people, and their labor costs still grew as a share of their revenue. They are paying more for less. To me, that screams cost pressure, not cost control. It means the wage inflation for the remaining drivers and workers is outpacing their price hikes and their headcount cuts. And what about service? Shipments per employee are down 4%. They're getting less productive, and you have to wonder if cutting staff is starting to impact that premium service they're charging everyone for. This is a long-term play. And this slide right here, this illustrates their foresight perfectly. They are intentionally maintaining over 35% excess terminal capacity. While their competitors are pulling back and selling assets, ODFL is keeping its infrastructure ready. Now, when the market turns, and it always turns, they will be able to absorb a massive influx of freight without even breaking a sweat. This isn't dead weight. It's a powerful coiled spring ready to capture market share at a moment's notice. A coiled spring? Or an expensive, empty garage that's bleeding cash every single day. That excess capacity comes with real costs: depreciation, maintenance, taxes. The depreciation and amortization expense was up 70 basis points year over year precisely because of this strategy. They are paying for a massive network that is sitting idle. In this market, that feels a whole lot less like a strategic asset and more like an expensive liability that's dragging down their margins right now. But their ability to carry that asset speaks to their immense financial strength. Let's move to Section 4. Forging shareholder value. You know, how a company uses its cash when it's under pressure, that reveals everything about management's confidence in the future. And ODFL is making some very loud, very bold statements with its capital allocation strategy. And this is the loudest statement of them all. $730.3 million spent on share buybacks in 2025. This is the ultimate sign of strength. When a company's stock is under pressure, management is stepping in with a mountain of cash and saying, "We believe our shares are undervalued. We're investing heavily in ourselves." This is how you forge real long-term value for shareholders. It's one way, certainly. It's also a great way to use financial engineering to prop up your earnings per share when your net income is falling. Let's be very clear here. Net income was down 12.8% in the quarter. By reducing the number of shares out there, the EPS decline looks less severe. It's a financial maneuver, plain and simple, designed to make the numbers look better than they actually are.
And while they're spending all that money on their own stock, look at what they're spending on the actual business. They are slashing future investment. Planned capital expenditures for 2026 are just $265 million. That's down from $415 million last year. That's a massive cut. So I have to ask, are they sacrificing future growth, new terminals, new trucks, new technology, just to prop up the stock price today? It really looks like they're polishing the brass on the fortress while letting the foundation crumble. That's a cynical take. I see it as prudent capital management. Why would you spend heavily on new equipment and terminals when you already have 35% excess capacity? They are aligning their spending with the current reality, preserving capital, and returning the excess to shareholders where it belongs. When demand returns, they'll ramp up CapEx again. It's flexible, it's smart, and it's disciplined. And it's not just the buybacks. They just added another layer of steel to their commitment to shareholders with a 3.6% dividend increase. This isn't a company that's worried about the future. This is a confident management team signaling to everyone that the cash flow is strong and they will continue to reward the owners of the business quarter after quarter. A 3.6% hike is barely keeping up with inflation. And again, is this the best use of capital right now? When your volumes are down double digits and your margins are compressing, should you really be increasing your fixed cash payouts? Or should that money be going into debt reduction or maybe strategic investments to get the business growing again? It feels like they're more focused on pleasing Wall Street in the short term than on fixing the fundamental weakness in their operations. Which brings us to the final showdown. Section 5, the verdict. Is this company truly built to last, or is it starting to crack under the immense pressure of this freight recession? It is time to weigh all the evidence and decide if Old Dominion is a generational opportunity or just a value trap waiting to spring. For me, the evidence for the bull case is just overwhelming. The fortress is holding. You have best-in-class pricing power, which proves their service is superior. You have disciplined cost controls that are beating management's own guidance. You have massive shareholder returns through buybacks and dividends, which shows supreme confidence from the inside. And you have a company that is perfectly poised for a rebound with all that excess capacity just ready to go. They have built a fortress that is designed to outlast any storm. But you can't ignore the storm that's raging right now. The bear case is grounded in reality. You have collapsing freight volumes. An 18.9% two-year decline is not a blip. It is a dangerous trend. You have a deteriorating operating ratio, meaning they are getting less efficient by the day. They are slashing future investment by gutting their CapEx budget, which mortgages the company's future. And critically, you have a negative spread between cost and revenue growth per shipment. It's costing them more to handle a shipment than the extra they're charging for it. That is an unsustainable model. The fortress may look strong from the outside, but the storm is actively eroding its foundations. So the final question you have to ask yourself is what you bet on in a downturn. I'm betting on the fortress. I'm betting on the company with the scale, the discipline, and the financial strength to weather this storm and come out even stronger on the other side. Old Dominion is that fortress, and these results, despite all the headwinds, prove it is absolutely built to last. And I'll leave our audience with this thought. In a rapidly changing, volatile market, is being a giant, slow-moving fortress a strength or a liability? While Old Dominion is so busy defending its walls, more nimble, faster-moving competitors might be the ones out there capturing the future of freight. The question is whether this fortress is a sanctuary or if it's simply a very large, very slow-moving target.